Hello, everyone. Good morning, good afternoon, and good evening, wherever you are in the world. My name is Torsten Kolind, and I'm the co-founder and CEO of a company called YouNoodle.com. We are based in San Francisco, California. So I'm here to tell you a little bit about company operations and how to structure your company, especially when you're in the creative industries. So perhaps let me start with just giving you a very quick overview of my reality here. So YouNoodle started 4 years ago and has 18 employees today, so still a startup, still fairly small. We have been through fundraising, and we've also been through a lot of revenue generation, as in selling our own products. The company does competitions for entrepreneurs, so basically an evaluation platform where entrepreneurs can apply to win grants and awards. And the platform can be used to judge and evaluate all of the incoming applications. So that's in use at universities, corporations, governments, nonprofits, foundations, really in a lot of different places. So that's the reality I'm in, and we are working on seeing if we get the Q&A panel to work here, but effectively you should be able to just ask me questions along the way as we go along. So I'm going to take you through two things today. One is, how do I look at budgeting and predicting, so to speak, what our income and expenses would look like over a period of time. And I want to show you basically a very simple model that you can use for your own business planning. The second thing is, I want to just show you briefly how the mechanics of fundraising works. So basically, if you have a company, which stock types do you have, and which types of investors do you get in, and how does that dilution of your ownership share as a founder work out over time in the company. I'm not going to show you any slides today. I'm purely going to take you through essentially two Excel sheets. So this is going to be a very operational presentation, but hopefully it's something that you find very useful. So let me start off by opening up the first spreadsheet that I want to show you guys. So this is the one about operations and how you spend your money. Hang on. So you should all now see a spreadsheet on your screen. And I believe, yes, I think it should be sufficiently maximized here. So what I want to show you here is a very simple model of how income and expenses work in a small startup. So in the model I've chosen here, you will see that I kind of have three different sections of the spreadsheet. I have my income is the first section, which is basically different types of products or services that you sell. The second section is called payroll, because that is for most tech startup companies your biggest expense. So really understanding how your money goes into the payment of your team. And the third section is the expense section. So this is about not just payroll, but also other expenses that you have, such as your rent and travel cost and sales and marketing, and really anything other than that. So what that gives us is a way to project that out over, in this case I've chosen 12 months, but this could just as well have been 3 years or 5 years or 6 months, or whatever is time period that you are interested in. Let's start perhaps with the first top section here about the income. So what's happening here is it's a very simple company. It has a product, and it only has one product. It's a scalable software product. So the way I have budgeted this out is I have basically just assumed that there was a stable growth in my sales, which, by the way, is never the case for startups. But in terms of making sure that you understand how I look at income versus expenses, I decided just to have a very basic projection where I have essentially a 50% growth month on month in my revenue numbers, which takes me from nothing in the beginning of the year to effectively almost $500,000 total for the year, whereas most is done really in the last quarter. So that's the first section. And the second section is my payroll section. And what you'll see here is that I have split up this section by line. So I have each person in the company has its own separate line, so I can put them in at different points as the company grows. You'll see in the beginning the company only has 2 employees, which would be yourself as CEO and possibly a head of technology in this case. And then as we grow, we add on more people to the team. And the number 5,000 was basically a fictitious monthly salary that I put in there to say, okay, what are we able to pay these people in the company? So what you'll see is including a little bit of sales commission for anybody who sells products that I define as 5% of the total product revenue, and what I call overhead. So this is essentially extra costs related to payroll, like you pay employer taxes, or in the US you have to pay insurances, medical insurance, and health, life health insurance for your. So that's what we call overhead, and that gives you per month an estimate of how much you spend on payroll. But for most startups, there are also other expenses. You have, if you look at the third section, the expenses section, I just take basically the number coming from the second section, the aggregate monthly number as payroll, and then I add in a number for operations, travel, sales and marketing, and other expenses. The percentages that you see out here are really mostly chosen so that you're able to vary this over time. So I could, for instance, say, no, I actually expect my travel costs to go up by 15% a month, and you'll see how that changes your numbers. So again, this is something you don't really know until you start off, but here at least I've just shared my initial numbers. So unsurprisingly, this is a company that, as you can see in the beginning, burns more money than it makes. So the first month we're making $19,000 of a loss, and that kind of slowly goes down, and eventually, as the company sells more and more products, we start seeing an increase in the or rather a balance that's now positive. So I made a couple of charts here just to show you how this looks if charted over time. So what you'll see is, let's start with the income here is the blue line. So the blue line is increasing gradually up, as I said, just kind of modeled out very simply. The expenses are not quite as clear. That's the purple line. But they go up by a little bit, and you'll see that break-even point where we cross the income, and that's seen in the yellow line, which is the balance line. So this is essentially your monthly balance that starts off being negative and turns into being positive. So what this also gives you an idea of is not only the break-even point, that is very, very important to know when that comes and how you're going to get there, but it also gives you an idea of total capital requirement for your company. So as you're making, in this case, consecutive losses month by month, this spreadsheet will help you understand what investment do you need to raise in the beginning in order to be able to do this. And in my case here, what you'll see is the line. Let me scroll down a little bit here. So there's a line I call CCF, which is short for cumulative cash flow. And what that shows you is if you start with money in the bank, let's say we had no money. I'm going to change this to 0. You basically see in aggregate how much money you owe the bank. And as we move along the line here, you are going to break even at some point. And you'll see that now this amount, which you see here as minus $149,000, starts slowly going up again. And essentially the low point of this line here is your total capital requirement. So in this case, we know we have to raise at least $149,000. And what I suggested here was that we would go out and try to raise $200,000 so that there is a little bit of a buffer of about $50,000 at the point where you have the least amount of money in the bank. So back to the charts here, that is the line, the top line you see here is downwards from a little less than 200 to 50,000, and then it goes up again as your company makes more money. So that's essentially your bank balance. And so I just wanted to show you those kind of break even and cumulative cash flow and capital requirement as three important concepts that any entrepreneur should know and should be able to understand their business in that context. So for instance, if we said, well, our sales didn't really progress as well as they should, let's say that they didn't grow by 50% a month, but they only grew by 25% a month. What you see is a completely different picture. So firstly, with the same expenses, we have a company that overall in the year, if you look at the very bottom right corner of the spreadsheet, you'll see that we're going to make a $275,000 loss over the course of the year. But more importantly, if you look at the charts, we're now not going to break even during this year. We might do it at a later point, but you see a totally different picture where essentially your income is throughout the year always lower than your expenses, and your balance is always negative for that reason. And consequently, even if we raise $200,000, we're just going to keep burning money, and it really doesn't look like it's getting better anytime soon. So this is a spreadsheet you can use to model out those decisions and say, well, what do I do? Do I go and get more revenue? Do I need to stop burning as much money? Do I need to let go of any people? Do I need to travel less? What are the decisions that I need to make in order for this to work out? And I think as a company and as a founder, you should absolutely know this very, very well and as much as possible. And as we're going to get into an investment talk in a minute, you will realize that this is also fundamentally very important for you to know in an investment context. So that was the operational spreadsheet. It looks like we're still without the Q&A pane here, but that's okay. What I'm just gonna hope that it comes in later on, but that's fine. What I'm gonna do now is I want to move on to the company structure and investment presentation in order to share a little bit of thoughts about how a typical in this case, tech startup company is structured. And bear in mind that my reality is that of Silicon Valley and San Francisco. So the way we do it here might be slightly different from in other places. But those of you that are looking to eventually grow in the US or raise funding in Silicon Valley, I think it would be useful for you to at least know how we look at funding rounds and company structures here. So that brings me to the next spreadsheet that I want to share. Just give me a moment here. So you should all be able to see this spreadsheet now. And there you go. So this is a slightly more complicated spreadsheet, but really not that much. I'm going to walk you through it just like what I did with the other sheet. So what I made here was a what's called a cap table, a capitalization table, which outlines the different stockholders of a typical tech company. And the blue sections you see on top are really different stages of the company where different levels of funding is raised. So you will see I can scroll from the incorporation stage across to seed round, across to Series A fundraising, a Series B round, and then finally in this example, I modeled out an acquisition by a big company and how the return on investment and the payout is for the founders as well as all the other stockholders. So that's what we're going to go through in the next 15-20 minutes. I'm going to start with the incorporation stage and go through a couple of basic principles of how most companies are structured. So the first thing is, when you start a company, you have a choice of any kind of number of shares that you would like to split this company up in. That could be anything from 2 shares to 100 million shares. It's really completely arbitrary at this stage because the company has no intrinsic value. So typically people go for fairly high numbers of shares just to make sure that that they are able to split them up later on in smaller and smaller chunks. So in the example I'm showing you here, we have a company with 1 million shares, and the shares are distributed. Initially, there is no money in the company, no investment happened, so they're distributed between the two co-founders. In this case, these are the names of Kathy and John. And under that, we have two early employees, or people that are helping out early on in the process. So the two co-founders have 40% of the company each, and the two early employees have 10% of the company each. So that's a very kind of typical initial scenario. You just incorporate the company. These are essentially the founding team of 4 people. There is no money in the company, so all of these numbers really don't mean a whole lot. Typically, you set an initial value of the shares, just so you're able to say, well, right now we're all going to put in, let's say, $100 as initial capital in the company, which prices each share at $0.0001 dollars per share. So again, it's arbitrary. It's so that there is some sort of basic initial value on these shares. As they increase in value later on, I'll show you how that dynamic plays out. So let's go through the first fundraising. Let's see how it works when we have an initial capital amount of, in this case, $50,000 offered to be invested by, in this case, really just the founders' own money and family and friends. So the $50,000 were the agreement that the founders had with the family and friends investors that came in, was that they would put in $50,000, but they would want 20% of the company. So what we do here is we do a little quick calculation that I'm showing you down in the bottom left corner as a stock price calculator. We say there are 1 million shares in the company pre-money, so before any money comes in. $50,000 is offered as investment. We want them to have a total of 20% after that investment happens. So with this very simple calculation you see up here, we end up with 250,000 new shares that need to be issued. So that brings the total number of shares to 1,250,000 shares. And of that, the 250,000 are now equivalent to 20%. It also shows you the corresponding share price, that if you invest $50,000, you need 250,000 shares. Consequently, each share is now worth 20 cents. So quite a bit more than the 0.0001 cent initially, but still a fairly low number. So in the dilution that you see up here, you'll see that the founders, the co-founders, are now down to 32%, early employees down to 8%, and your new investor is now at 20%. So we're still adding up to 100,000 here. So before I move on to the next round, I just want to introduce the concept of pre-money valuation and total company value, because a lot of investors will essentially ask you about that. So the pre-money valuation is the valuation that the company has right before the money comes in. So if your investor says, I am willing to give you, in this case, $50,000 for 20% of the company, that investor is essentially telling you that what you currently have, the other 80% of the company, I believe that they are worth $200,000. So it is sometimes a little arbitrary, because why is it worth $200,000? Well, essentially for most early stage startups, that value is just defined by what the investor is willing to take. So you could argue, no, I think what I have is worth $5 million, but if the investor says, well, that's fine, but then I can't give you my money, then most founders end up, being willing to take the valuation that the investor will give them. Later on, there are other ways of valuing companies, and as a startup grows, you get into some more traditional ways of valuing companies. But in the beginning, essentially, most companies are valued by what the investor is willing to take. So the pre-money valuation in this case was 200,000, and consequently, after you put in an additional 50,000 in cash, the total post-money company value is now $250,000. Okay? So knowing that, let's move on to the next funding round and see what happens when we raise a little bit more money. So I'm now moving over to the Series A. And what happened between the seed round and the Series A is that those 50,000, the founders now spent on building out a prototype and building out the first iteration of their product. They may have hired a few more people. They may have, tried to basically move some things around to add value to the company. And then the company goes and asks or seeks further capital. And in this case, they successfully managed to convince a company that I have called First Round Capital, you'll see it over here, to invest a further 500,000 in this round. So you see it down here in money raised, $500,000. First Round Capital said, well, I'll give you $500,000, but I want a quarter of your company. I want 25% of your company. So we go back to the stock price calculator here and say, okay, so we now 150,000 shares. And actually, what I should also tell you is that the company at the point of the Series A decides to allocate 250,000 shares as options for future employees and key employees in the company. So that's really just reserving shares, so to speak, for employees as they earn them, as they perform and do really well in the company. So really, we actually have 1,500 or 1.5 million shares at the point where First Round says, I'd like to offer you $500,000 for 25% of the company. So we're going to punch that in right here, and we're looking at 25%. And what we see is that we need to issue 500,000 new shares, and the share price has now risen from $0.2 a share to $1 a share. So that's what you'll see I put in over here in the Series A section. I put in the 250,000 options, the 500,000 shares, and I now am up to 2 million shares. The company has a pre-money valuation at 1.5 million. Then First Round puts in their additional 500,000 is now at a post-money value of $2 million. Okay. So let me just explain the concept of options a little bit more here. And I think I also want to explain the concept of common stock versus preferred stock before we move on to the next half of this spreadsheet. So when we have, so go back out here. When we have, let's start with the options. So most companies in the beginning are not able to pay as high salaries as many larger companies can. So, but what they do have is essentially a lottery ticket that this company is going to be worth a lot of money one day. And just like that's what motivates founders, that's in many ways also what motivates early employees, because they know they're taking a risk by working in this company. And in order to take that risk, they also want to have part of the upside if this company becomes worth a lot of money. So the options is a way that you can give out ownership in your company, but without necessarily giving it all out in the beginning. So options will allow you to do what's called vesting, which means over time, as the employees or early team members add value to your company, more and more of those options vest, i.e. they become property of the employee. So it's a way where you're able to tie ownership in the company to their continued engagement in the company. And most options actually in Silicon Valley are set up to be what's called a 4-year, 1-year cliff vesting schedule. And what that means is if you get, let's say, 100,000 shares in options, they vest over 4 years, but the 1-year cliff means that the first 12 months, nothing vests. So as an employee, you have to actually be in the company for at least 12 months before you get any shares. And then at that first anniversary, after 1 year in the company, you have the first chunk of 25% of those 100,000 shares vested in one go, and then they typically vest month by month until the end of the 4 years. So that's typically the way that you can use options to give ownership in your company, but over time as they spend more and more time and energy and effort on building your company. So that was options. The other thing I want to mention was the common stock versus preferred stock. So let me just for a moment go back to the spreadsheet here. Common stock versus preferred stock is essentially a way that investors are protected when they make investments in high-risk tech startups. So what you'll see here is that the founders all have common stock versus investors that put in hard cash into the company all have preferred stock. So that essentially means that in the event, let's say that you started off raising your $50,000 and right afterwards the founders agree, we don't want to do this anymore. We're done, you know, they had a disagreement and it's a really bad idea to do. But at this point, the new investors really only had 20% of the company. So if they invested $50,000 and you liquidated, as it's called, if you liquidated the company, the new investors would only take back $10,000, and all the founders would take the other $40,000, which arguably is a little unfair because it's just a week after the investors put in money and nothing has really happened. Everyone just agreed we don't want to do this anymore. So the idea of preferred stock is to essentially give what's called a liquidation preference, which means in the event of you closing down the company or actually selling the company, any kind of liquidation that stops the company from operating, those $50,000 need to be paid back to the investors before anything else is paid out. So in the scenario I just explained, if you wrap up the company a week after that $50,000 came in, and let's say you spent the first $2,000 on legal bills or something else, you have $48,000 left in the bank. All of those $48,000 will go back to the first investor, and the founders will get nothing. And in my mind, that is totally, absolutely fair because nothing had happened with that money, and the investors should be protected. So that is the idea of preferred stock. And as you go through multiple rounds of funding, you actually have multiple levels of liquidation preferences. And generally speaking, it's always the latest money that comes into your company that has the highest preference in the event of a liquidation. And I'm mentioning this because you will hear more about this when you get to the concepts of valuing different share types. So preferred stock is generally what we talk about the value per share as here, the 20 cents per share, that would be for the preferred stock. The common stock is going to be somewhere in between the 0.0001 and the 20 cents a share at this point, because of precisely that. If you wrap up the company, you don't get any money out of it. And there are some complicated valuation models for that, but I just wanted to make sure that you understand the difference between common and preferred stock, and that the difference predominantly lies in the investor protection and the liquidation preference in case you wrap up your company. Okay, so let's move on to the concept of no, actually, let's do one more funding round, and then let's look at acquisition. So the Series B round is essentially, mechanics-wise, works the same way as the A round. However, in this case, we have a new investor, but we also have an existing investor that chooses to continue engagement in the company. Let's start with the new investor. The new investor I called Sequoia Capital, and they offered a $2.6 million investment. So quite a bit up from the $500K that you raised in the previous round. So the $2.6 million investment, they offer to put in at an $8 million valuation, pre-money valuation. So that's what you see up here. So effectively, given the simple math involved here, that will give them at the end of that process 19% of the company. So they say we'll give you $2.6 million and we'll do it at an $8 million valuation. But what actually happened in this case here was that first round capital said, no, we'd actually like to participate in this second round here. We want to try to keep our fractional share of 25%. So why don't we share this amount so that we're all able to participate on the same terms here. So what happened in reality is actually that Sequoia put in $2 million, and first round put in an additional $600,000, which brought the total to $2.6 million. So it's very common to see existing investors continue to participate in rounds as you move along, because they are already in and they still believe in the company and they don't want to be diluted, and they typically have follow-on funds that they set aside to do precisely this. So the math here works out on an $8 million pre-money valuation. The math works out to be $4 a share on that valuation, and that gives us now a total company value of $10.6 million. So we went up from $1 a share to $4 a share from round A to round B. So something good must have happened. They must have hired more people, sold more of their product, built out more stuff. So looking at the dilution here, the founders are now all the way down to 15% from the initial 40 that they were at. Early employees at 4. Our options pool is now at 9%, which is very normal at this stage. And then our initial investors, who remember used to have about 20% of the company, they are now below 10. First round keeps its fraction at 25 because they reinvested in this round, and then Sequoia ends up with the last 19. So that's the process through the B round. Then what happens afterwards is that Google comes and says, we would love to buy your company. We believe you have created something really impressive. And they offer you $40 million for your company. So this is in many ways the exit that many entrepreneurs are working towards or dreaming of. The amount of course can be anything, could be billions of dollars, but in this case, given the size of the company and the stage, $40 million is a pretty realistic bid. So what happens is that with a $40 million total value of the company, the company has now gone up by about 4x from the initial, or from the 10 million valuation that it had right after the past B round. So what that means in terms of value per share is about $15 per share. And consequently, we can now start looking at what is the return on investment on all of these payouts. So initially here, we see the two founders come out with about 6 million each. The early employees come out with 1.5 million. The options, depending on whether they have vested or not, in the event that they have all been allocated and vested, would split about 3.7 million. And that's, of course, a payout to the founders and the team that everyone is happy with. But it doesn't really make sense in terms of the return on investment, because they didn't really put in any money here. So let's look at our three investors and see how did they come out of this in terms of the return on the investment they put in. So the initial early stage investors that put in the $50,000 are now getting 3.7 million, which is an amazing return of 75 times as much as they put in initially. But that makes sense because they took the initial risk, and they took the risk where there was no value in the company. So it's only fair that they get such a high return on their investment. The second investors were first round capital, and they did remember the A round and the B round. So the aggregate of their holdings now give them a roughly 8.9x investment of the money that they put in, and they go out with almost 10 million out of these 40 million. So what for them, for a venture capitalist, that's a pretty good return. They generally go for about 10x on the money they put in. So first round is probably pretty happy at this stage. Sequoia put in money later on. So although they actually put in more money than first round, they're only getting about 3.8 times their money back. And that for a VC is actually not a lot. So although for you founders, this may look like a great exit, for Sequoia would probably say, nah, we didn't really get much out of this, and would actually, in many cases, consider this a failure, or at least not a success in their books. So it all depends on when you get in terms of investment, and what the valuation is, and which round you're in, and of course on the overall acquisition price. So the overall return on investment was about 13x, which is definitely very good for a venture funded company. So that was a little bit about the different rounds in the acquisition, how that all worked out. And I should probably mention, as these numbers are done up, I'm assuming here that all shares are converted into common stock, which is, I think, a little too technical to go into in this stage. But you do see some acquisitions where the money, because there's a liquidation, the money is paid out first to the preferred stockholders, and then the rest is split among common stock. But the bigger the acquisition price, the more likely it is that everyone will just be treated as common stockholders, and thus the acquisition amount will be split evenly. So I just want to mention that I did that assumption here. So I think that's probably all that I wanted to share about the mechanics of dilution and fundraising and different rounds and different types of investors. I hope this was useful, and I'll be sure to share any of these documents with you guys so that you're able to use them as worksheets, because obviously everyone's situation is different. Some will have more founding team members, some will be at a later stage already, some will have perhaps not equity investors, but maybe grant money. So there are all these different scenarios, and I think it's just important that you know some of those basic tools, and that you realize that you don't necessarily need to hire a full-time CFO or accountant to help you get this right. Really, most founders, I think, ought to have a very solid understanding of the cash flows in and out of your companies, but also of the stock types and the funding rounds and types of funding that you take as you develop your company. I think that it's something that we should all embrace, and it's a core part of building a value company for the long term. So given the fact that the Q&A box is featured, I think what we're going to do is let's have the CBC team take any questions by email. I'm happy to be connected to any of you and help you out with what you're doing. And hopefully I'll see many of you in November in Copenhagen. So thank you very much here from San Francisco, and good luck building your companies.